Here today we're going to do another interview with Raj Kapoor. We'll talk a little bit about his journey and the what's happened since the last time we saw him. I think it was a year ago, 1.5 years ago. I want to hear his views on markets in Asia, reforms and so on, and also talk about what he's doing at Smartkarma, including his recent initiatives that I will let him introduce. As always, remember that none of this discussion should be taken as investment advice. Is purely for informational and educational purposes. Speak to a financial advisor before making any investment decisions. So, welcome, Raj. Last time we spoke, we had an interview, maybe like an hour, and that interview had so many views, so many downloads, and so many shares. It was one of the most popular posts I've ever done, I think. So very happy to have you on again. And for those of you who haven't seen you before, could you give you a brief introduction about yourself and what you do at Smartkarma?
Hi, Michael. Nice to be back on your podcast. Really good to hear that the previous interview had a good reception from the audience. Very briefly about me, I am the CEO and co-founder of a business called Smartkarma. We run an investment intelligence platform that serves institutional as well as individual investors. We've been around for about 10 years now, and we're backed by several institutions, including the Singapore Exchange, Enterprise Singapore, Sequoia, which is now Peak 15, and others. We started off with a very heavy focus on Asian markets, a nice overlap with what you do at Asian Century as well. And I think over the years, we've continued to deepen that focus across public markets. And most recently, we've just announced the launch of privatiq.com, where we would be focusing also on unlisted companies, which is a very large asset class now in Asia also.
Okay. And what's your current focus on a day-to-day basis? Just curious about your personal investing and your personal research diet. Where do you put your most focus right now in terms of where you should value and also where you think
I think for me, Smartkarma works out really well because it's a really nice marriage between my first love, which is technology, and my second love, which is investing. And I happen to sit in the middle of about 350 different research and data providers who sort of publish and distribute their research and data through our platform. So I continue to invest in a personal capacity quite systematically and in a disciplined way. I've done so since 2006. It's coming to the 20-year mark. I do not have any particular mandate in terms of sector, style, or region. I tend to be quite bottom-up in what I do. I've discovered that I do not have an expertise in calling macro. I almost always get it wrong. So we try and just focus on companies, their stories, and their growth patterns. As it happens, in the last few years, the best opportunities that I've seen in markets have been in Southeast Asia and more recently in North Asia, especially South Korea. But look, that could change over time. But that's where I'm putting most attention at the moment.
Okay. And last time you mentioned that you pay great attention to, or you emphasize dividends, which I think is really interesting because a lot of investors these days, they're focusing on compounders, Berkshire Hathaway style companies that just reinvest everything. But you've taken a different approach, which is really contrarian. And I'm curious to hear, how do you view that?
Yeah, look, for me, it's it's not so much the absolute dividend yield. So I'm not an income investor, but perhaps what I pay a lot of attention to is the growth in absolute dividend over time. So I'm looking at dividend compounding, not necessarily what the absolute level of it is at any given point of time. And the reason I do that is because it actually marries two important characteristics in a company that I look out for. One is a good sort of growth, steady growth, but also minority friendliness. And to me, the best way to judge minority friendliness is them returning capital to us now, as opposed to constantly reinvesting it in something that may or may not prove to be a good capital decision over time.
Yeah, makes a lot of sense. So you're based in Singapore, and I'm really interested to hear about what you think about the market right now. Last 2 years have actually been quite strong. Nobody expected that, but the index is up almost 50% since
Yeah.
2024.
Yeah.
What do you think that is? Like, what changed to cause this enthusiasm to kind of bubble up?
Yeah, I think it's two things. I think the first part of that time horizon you mentioned was just due to the fact that when you looked at Singapore relative to other Asian and Southeast Asian economies, you saw you saw a very stable environment in the face of a very a geopolitical environment that was in a lot of flux, and also a tariff regime which was very uncertain. And as we saw, Singapore was one of, I guess, the winners in both of those dimensions. So I think that worked out well, and we had fairly conservative valuations to begin with, and some companies that were delivering, especially the large caps, very, very stable and steady earnings.
Hmm.
Now, in the second half of that regime, we've started to see a very heavy focus from the Singapore large cap corporates, especially on value unlocking and capital recycling, and returning money back to investors and all the good stuff that institutional investors especially like to see. I mean, I think we saw the best quarter that Singtel has ever had in sort of forever. We saw Keppel selling off non-core assets. We saw the Jardine Group that's listed in Singapore as well,
Hmm.
doing a lot of minority-friendly things. I think what started off with the Temasek linked companies started to proliferate across other large caps. And then the third part of the horizon has been very, very policy and reform led. I think the Monetary Authority of Singapore, the central bank here, coupled with the Singapore Exchange, as well as cabinet members, launched something called EQDP, the Equity Development Program, in November of last year. There were many facets to it. There was an element of injecting capital through funds to really channel money into the smaller and mid cap names. There were supply side reforms to get better IPOs coming to market and more IPOs coming to market. There was a lot of emphasis on improving research, data, disclosure, etc. And then, most importantly, there is a lot of emphasis now, and increasingly so going forward, on value unlocking. I think we recognize that similar efforts have yielded very good fruit in Japan and to a certain extent in South Korea. And that is now sort of a big policy imperative in Singapore too. And ultimately, the corporates, the issuers that are listed here, will be encouraged, if not nudged, into doing similar things. And I think the market is responding very, very nicely to it. We actually, I don't know if you know this, Michael, but Smartkarma actually publishes a monthly column in The Edge, which is a local business newspaper. It's called um, uh, Value Talk Real Walk, where we actually specifically outline corporate actions that are being done under a value up or value unlocking mantle by corporates. And I think the number of corporates that are starting to jump into that is increasing, and it's very, very encouraging to see that.
So what's leading to this interest in improving corporate governance or improving capital allocation? Because some of these companies are Temasek owned and some of them aren't. Are companies trying to qualify for investment by these equity market development, program funds, or is it something else? Is it kind of nudging from the regulator?
I think it's all of the above, Michael. But if I have to pinpoint to kind of what I think is the kernel of what's driving the change, I think it's policy making. I think the policymakers have made it clear through direct speeches by cabinet ministers, by specific policy announcements, and then also by TLCs taking leadership that they want to see corporates do right by shareholders. You know, if so, and I think a lot of these companies are sitting on excess cash or non-core assets. There's a lot of small conglomerates in Singapore, and I think now with valuations having lifted up 50%, as you mentioned, it becomes easier for corporates to start shedding off assets or returning money back, and then creating that virtuous cycle where that gets rewarded more and more by shareholders too.
Okay. Do we know which stocks or which companies these EQDP funds have invested in? Like, what are they focusing on? Do you know?
Actually, there's been a lot of front running of that
Yeah.
government capital. So people have generally invested across the small and mid caps. I'd say sort of everything beyond the top 30 or 50 names has seen a bigger uplift. But now that that MAS capital is starting to get dispersed into funds, we'll start to see, you know, not like an uneven performance from here on. And I think institutional capital will look for a certain degree of liquidity so that they can scale their allocation into companies, but they'll also look for management teams with whom they feel comfort in the journey for the next 3 to 5 years, because you there is always that danger that once the liquidity dries up, what happens? So I think the combination of good actors and sort of good stock characteristics is going to be in focus. Again, you know, Smartkarma very strongly felt that what South Korea did with its value up benchmark was a very brilliant idea to systematically shed light on what these types of corporates might be. So for us, we actually launched a set of indices and in the market about a month or so ago. They are called value up indices. And we've got a few variants. We've got a all cap variant. We've got a small mid cap variant. We've got a liquidity enhanced variant. And I think we release some of the constituents, the top few constituents, on that website quite transparently. And I think soon we will allow people to be able to subscribe to see changes over time as well as members sort of change. But I feel that we're sort of in a very early innings of the value up journey of Singapore. The first innings, there's a bit of a hope trade and that'll settle down. But I think from here on, there will be some very, very specific initiatives coming out to help corporates actually embark on the right corporate actions, the right transactions, the right sort of interactions with investors as well. So, and as you know, when the Singapore policymakers galvanize around a particular idea, the execution tends to be quite strong. And I'm very hopeful that we're starting to see that.
So in comparison, what do you think made the Japanese reforms and in Korea, their value up programs, what made them successful, at least in terms of performance? And I think also in Japan, I mean, we've seen a large increase in share buybacks and cross holdings have been reduced and so on. So it seems like that those efforts have been really successful. But what do you think was the leading reason for success for Japan's forms?
Yeah, my friend JP Yong, who's one of the anchors at CNBC, he called it the Ginza reform and the Gangnam reform, respectively. But I think the Ginza flavor was a very different flavor. I guess it was very much pension fund driven to a certain extent, given the large domestic shareholdings of the pension funds. Once the pension funds got behind the idea that value up, value unlocking, doing right by minorities is the fair way, and there could be benefits in terms of moving valuations up. I think the sort of TSC imperative to create name and shame lists or encouraging companies trading below 0.5 price to book to either do the right thing or see institutions selling their current shareholdings. It became a very, very, very stark thing. And I think once some of the corporates started to do the right thing, their share prices reacted positively, and that got others to follow. So that was the flavor in Japan. And I think that's why, if you look at the outperformance that we've seen in Japan, a lot of that has come from these small companies. Now, if you look at South Korea, very, very different approach to a certain extent. Again, yes, with South Korea as well, given the poor demographics over time in that market, they've got a looming pension crisis. And they knew that asset values had to be rewritten up, right? So the pension funds wanted things to be done, but they did it a bit differently. They went and they created the value of benchmark, which is a different tracking index compared to the local Kospi. If you go to the Korea Exchange website, the KRX website today, the first thing you see on the ticker is no longer Kospi. It's the value of benchmark. And I think the pension funds have committed to moving their allocation to this benchmark every quarter over time. So again, very clear signal. And the sort of the metrics that you need to display to be part of that benchmark are transparently known. This is not a black box. So it's a very, very clear way to send a signal to corporates that hey, if you do well on this report card, which is publicly known, you're going to be part of the benchmark. And if you're part of the benchmark, you get capital allocation from pension managers. And if you're not in the benchmark, you don't. So it starts to get corporate behavior changing quite nicely. I think so. That's been the flavor in North Asia. And I think hence the responses have been very different. And the constituents of the market that have taken the first steps have been very different. Now, if you look at Singapore, I think the corporate sector, to a small extent, front ran policy. The TLC started to change because I guess there was an imperative from Temasek itself, being the shareholder, to see better returns from some of these corporates. So it started there. But at the same time, or perhaps in parallel, policymakers started to fundamentally reshape the incentives for investors to participate in the market and for issuers to come and list in the market. And then the last part of that puzzle is how do you then get the listed issuers to change their behavior as well? What are the incentives for them? And what are the disincentives for them not to? So that typical carrot and stick. And I think one of the recent cabinet minister speeches gives a lot of detail on what's still to come in that direction.
Okay. Now, I've been a little bit skeptical, I guess, about Korea's ability to reform with high inheritance taxes and also high dividend taxes. Some companies, they're about to bequest the assets to the next generation. They tend to press down the share price, or at least not promote the company. Do you think that's going to change? How do you solve that issue?
I think you solve that issue by bringing in private equity players, because I think you might the company could first be taken private, restructured, inherited in the right way by the next generation, and then pieces brought back to market later. So actually, I think from public to private and back to public is going to be the route that is taken to solve some of those structural issues. But I think, look, that's not the, I think those types of situations, yes, a lot of them exist, but there's like a lot more in the market, which is not chaebol structure, which is not impacted in the same way by inheritance taxes and so forth. And look, if you think about rate of change, right? I mean, what took Japan 5 to 10 years to achieve in terms of changes to their stewardship code? Korea was able to compress that in, let's say, 2 to 3 years. So I think there is, and again, with these things, right, success begets success. Now that the wheels have been set in motion, I mean, Korea, you talked about Singapore's performance. Look at Korea's performance this year. So I think this will just encourage more of the same. And I think at some point of time, that economic incentive will trump most resistance, I feel. As long as you can bring the right incentives to table, things will evolve in the right way.
So let's talk about a beneficiary then of this value up index. FN Guide. I mean, I know you've been very positive about the long-term earnings outlook. What do you think about FN Guide today?
It's a very tiny stock. in Korea. I
Sure.
mean, 60, $70 million market cap, but it's a company that really intrigues me. I think it was a long time ago. It was Samsung money. It spun out. There was a management buyout. But just fast forward to now, it's one of the most interesting index providers in Korea. They provide indices that are used by, I think, every single domestic asset manager now. They've gained commendable market share in what has historically been a big boys club. Um, and I think they've been very, very innovative in the type of real-time indices that they have released, which have caught fancy with the investment managers in Korea. Um, so today, I think they are the world's cheapest index provider, and growing faster than most other index providers. But very few people recognize that they were also, as a stock, as a company, they were also the first company to announce a value up program on the Kosdaq, first Kosdaq listed company. So I think their dividend payout ratio has gone up from 20 something percent to nearly 60%. They've balance sheet, they've fully deleveraged, they're a net cash business now. The business is growing extremely fast. They just reported Q3 numbers. The index business grew 50% year on year in terms of top line. Profits are up triple digit. The rest of the business is also financial data, market data business, pretty high margin. The operating profit margin used to be about 20%. Now it's in the 30s. A lot of fundamental improvements in a stock that has no research coverage, not hugely liquid. It's okay. It's decently liquid, but not hugely liquid. But if the Korea reform continues to gather pace, which I think it does, and the capital market continues to be healthy the way it's been for the last year, then yeah, FN Guide is definitely one of the biggest beneficiaries. I mean, it's on 9 times earnings with a 60% payout, growing earnings triple digit year on year. If you compare that to the large index providers in the world, the S&Ps, the MSCIs, it's less than one-fourth the valuation. So
So
that's quite unique.
what's led to them taking market share? Is it because of thematic ETFs, or is there something else that's led KRX to lose, relatively speaking, or FNGI to win?
I just think more innovative indices, and those indices have seen greater adoption by asset managers, and I think the ETF market as a whole has taken off beautifully in South Korea, and it's still tiny compared to, whether it's on a per capita basis, savings adjusted basis to, let's say, the US market. I mean, in the US, if I'm not wrong, there are more ETFs than stocks now, right? So I think there's a long, long runway. People don't realize it, but I think asset managers want index providers, especially domestic index providers, to gain more share. And similarly, they want these guys to provide interesting products, so indices that can be used to build interesting products. As an example, there is a very popular ETF in Korea to own Indian exposure. They like it. And now, I don't think KRX wanted or had a strong incentive to go and create the underlying index for that product. So I think you need privately owned entrepreneurial smaller players, not necessarily exchange owned index players, to grow into that space. We saw similar stuff in Europe as well. And we've seen similar stuff happening in the US as well. So it's a dynamic that has existed in other markets. And it's just so happens that the player in Korea that's taking that charge is listed, and you can actually get exposure to that.
Interesting. So I'm guessing you speak to institutional investors a lot, on an everyday basis. Do you have a feeling for what markets they are interested in right now? Like, where are they over allocated to, relatively speaking, in terms of Asian markets, and where? And which markets do you think are completely, disregarded right now?
Okay. Look, I think if you break institutional investors into 3 categories, which follow the sort of 3 big benchmarks, there's the global guys, the global emerging markets guys, and then the APAC guys, right? So if you look at the big global guys, frankly speaking, I mean, for them, the story is all about S&P. It's all about the US overweight, and within that, it's all been the big companies. I mean, stock picking in the US market has never been easier because you actually have not had to pick stocks. The largest stocks have also grown the fastest. So that's where the global money is for the global funds, the global benchmarks. Then if you look at the global emerging market benchmarks, these guys, in the last few years, I think the Middle East has risen a lot. It's still not a consensus overweight, but it's gone from like non-existent to being a pretty important one. I think there's been a return of some of the gem money back to China in the last 12 months. Um, you know, Jury's still out on those funds that have US LPs. I think that's still very, very difficult. But there are other gem funds that have certainly taken that contrarian stance, given the valuations, to return to Chinese markets. India has been a problematic overweight for everybody. And it always has been, it never gets cheap. But just given the sheer size of the domestic liquidity pools, you're fighting against that domestic liquidity that keeps buying stocks. But I think people have enjoyed it, that India overweight, up until 12 months ago. It's sort of last 12 months, it's been flattish for most people. But, India is a big focus area for everyone at the moment. The market has, a lot of primary issuance as well. And a lot of that is in the new economy space. So you don't want to miss it if you're a big structural investor. That's been big. I think Taiwan is one of the biggest overweights for everybody in gem markets. It's just the best way to play so many thematics that point to new economy, whether it's semicon, whether it's AI capex, digital infrastructure, you have it. And again, it's some of the companies there have amongst the best return metrics of any company in Asia. So been an easy overweight. Getting to be a tricky overweight now. It's very, very expensive. Everything is several standard deviations over long-term means. So I think this year it's all been about Korea. And of course, it started off with semiconductor, but we're starting to see this in many, many sectors now. So I think the Korea thing is catching weight amongst gem guys now. Now the underweights, I mean, ASEAN. ASEAN's been the easy underweight. It's small in the benchmark, so some markets like Philippines, you can just completely ignore them. It's not going to hurt you very much, so why bother? Why put in the effort? Other markets like Indonesia, have troubled people because people were quite bullish, despite the transition out of Jokowi and Prabowo administration, but that started to there have been some visible cracks developing around that narrative. We've seen Thailand really disappoint investors. I think the political cycle has unfolded in a very messy manner, and that has really shaken out belief for people. Plus, the economy has just not recovered post-pandemic in quite the same way that other markets have. So I think ASEAN's an underweight. I think some people now are increasingly thinking of making India an underweight. I think it's a tricky call. It's a bold call, but people are thinking of what to use to fund more exposure to China and Korea. But I think North Asia is typically where most people are very focused at the moment, and nobody is prepared to take a contrarian valuation call into markets like ASEAN, which are like very, very cheap. So that's the situation there. And then within the APAC benchmark itself, right? Like given it's APAC, Japan is included, so Japan becomes a big part of what people are doing and involved in. It's just a very, very easy market for people to deploy large sums of capital in without worrying too much about tariffs or a lot of the things that are plaguing other markets. Vietnam is an important focus for everyone now, because it looks quite likely that it'll be moved up from frontier to emerging markets next year. And the economy is on fire. Absolutely. I mean, I was just looking at October trade numbers, just amazing, amazing volumes. So I think you need to allocate to Vietnam with a 10-year view, and people aren't there. So that's happening. I think Hong Kong is starting to show very, very credible signs of being in a much better place than it was last year or even 3 years ago. And people, there's a lot of big underweights there. Hong Kong real estate as an example, Hong Kong financials as an example, and that started to hurt people this year. Like HSBC trying to buy out Hang Seng Bank. I mean, you know, Hang Seng Bank used to be a consensus overweight for many years, for many managers, but it hasn't been for the last 3, 4 years. But these things are now coming back very nicely, very strongly. So there's repositioning there.
Okay. And with regards to Japan, do you still have exposure to Japanese SaaS companies? Or what do you think about I suppose
I do.
the risk to them from generative AI tools and the easier production or development of software? Do you think that's going to hurt them, or have you changed your view with regards to them?
No, look, I mean, there's two parts of this, right? One is if you have a thesis and you've invested, you track earnings, right? And you track whether that thesis is playing out. So when I look at the commentary and when I look at the earnings, my thesis is very much intact. I see fantastic performance from the companies from a very, very bottom up level. And then when I look at how are they responding to AI? How are they positioning themselves to be AI winners? I think almost all of them are using AI to lower or improve their cost structures. They're using AI to improve the appeal and stickiness of their products. They are, you know, and so I can see how AI is going to support margins and potentially improve demand for them. It doesn't seem like a bad thing. So I think this whole narrative about it becoming easier to code. Okay, I think like if you look at when Microsoft launched, Windows or Microsoft Office or whatever, from that era up until now, it's progressively gotten easier and easier to code. Yet no one's displaced Microsoft from its enterprise IT stack. So I think a lot of the moat of these companies has never been about code. The moat has been about switching costs. It's building the network effect or building the switching cost. And so long, I mean, so long as the switching cost is high, your product is sticky enough. Who cares whether somebody else can build your replica for cheaper? It just doesn't matter. I mean, look at accounting software. How often are corporates going to change their accounting software for a 10% discount? I know Smartkarma won't. These are so. I think I
Would you
feel
say,
the
yeah?
I
Would you say,
feel there's
would
yeah.
you
Sorry,
say,
go ahead.
would you say consumer SaaS is also safe then? I can imagine that enterprise SaaS is quite sticky in terms of their switching costs. But consumer products, I suppose simple features or simple software could potentially be replicated.
Again, I think it depends. So, when you're thinking about consumer SaaS, give me an example of a business you're thinking about.
Let's say Evernote, like note-taking apps. But I guess even before this, even before AI, there were tons of them. So the success of any given one was more about marketing, perhaps.
Okay, I think there actually the switching cost is extremely low, and the reason is because let's take that Evernote example. You could always download all your notes and move them to another application. And I think there the switching costs are higher for people who've got a bigger stack of solutions for you. So if Microsoft has OneNote or whatever their thing is called, or Google has Keep or whatever, and you can just upload your Evernote stack into it, you'll just move because it's the simplicity of being in that one ecosystem where you can transmit from A to B a lot easier. I think so. Yes, that's. I think so for me, it's about just testing what that switching cost mode is of that business, because that cost is actually when you look at cloud providers, right? I mean, cloud you could call like cloud enterprise SaaS or enterprise SaaS infrastructure, but actually in some ways it's consumer SaaS as well. We use it for many things, but just because another cloud provider gives you a discount on your annual bill doesn't mean you're necessarily going to move immediately. The operating friction involved in moving from one cloud provider to another is tremendously high. So it depends. It's like banking accounts, right? What gets you to shut down your principal bank account and move it to another bank?
Just quick question. Which Japanese SaaS companies do you think I should write about? Is it okay? Or do you want to talk about specific companies? You don't have to.
Okay, so I think with Japanese SaaS, right, there is this really nice sweet spot emerging where there's a bunch of companies that are around 500 million in market cap. And some of them even trade like 10 million US dollars a day, but there's no coverage.
Yep.
Okay, to me, those are really interesting. And then within this league, there are some companies that have always been pure SaaS, like from day one. But then there are some companies that have moved from being, IT companies doing project work into being product companies building SaaS. I think there's quite a lot of value that you can add from a research perspective in pointing out that transformation and how it's changing and so on. I was looking at a couple of legal SaaS businesses in Japan. They had results too. Like one of them had results this morning, fantastic results, but that's a transformation story. Um, of
Bengal 4 or
yeah.
yeah, okay.
Again, $400-500 million market cap. I don't really have a view on the stock or that space, but just to your question, I think those are really, really quite interesting. Then there is the other segment, which is $1 billion to $3 billion in market cap. I think that's super. Like those are the guys that have actually, some of them have expanded beyond Japan successfully. So that's super interesting because Japan's like not many Japanese companies have had success in building businesses beyond the shores of Japan. But I think tracking some of these to get evidence that if they are successful, then that'd be interesting. So like, I follow Appier quite closely. Appier is an interesting one. It's actually not a Japanese company, Taiwanese company that's listed in Japan. And in the last 3 years, they've managed to get a very nice foothold in the US market. And they are very much on the cutting edge of AI. It's actually been an AI company from the time of inception. But yeah, very, very ignored. It's 3 times EV to sales. Again, growing triple digits, net cash, paying dividends. I mean, these sorts of businesses don't even pay dividends in other markets.
Interesting. So, what about Southeast Asia? Is Philippines still your focus market? Are you equally bullish or equally positive about the long-term prospects for Philippine equities?
Look, I think Philippines is a massive outlier in like even within Southeast Asia. Like the sort of long-term GDP to market cap ratios, like a lot of those things are ridiculously like all-time low market cap to GDP. So it's like Philippines is a market that's been shunned by everybody, globals, locals, everywhere, which in itself makes it very interesting, right? Just from a contrarian value perspective. Then the other crazy thing is that there's a lot of very good natural monopolies in that country. And these guys have been around for donkeys and they've withstood economic cycles and they've continued to do the right thing. Some of these are family owned, so they have to return capital back because the family needs it. I mean, those are to me, like they fit my framework. And honestly, I don't really need to think too hard about how the world's going to end up being. And, as long as these companies are growing, they've got natural monopolies, they are returning capital back at some point of time. Maybe it's not in the next 3-5 years, maybe it's longer, but at some point of time that, the market forces will dictate a mean revision on the bigger macro and the bigger interest in equities. And then you will get a massive re-rating. I mean, if you go back to the mid 2000s, if I'm not wrong, UBS ECM made more money in Philippines than they did anywhere else in Asia. So the tide can turn.
Yeah.
And I don't know when it'll turn, but right now the bottom up opportunities are just insanely good. So I definitely want to be positioned.
Mm.
And in all of these cases, right, you get a double digit IRR, low double digits. I'm not saying 30%, but you'll get a 10 to 15% IRR without assuming anything overly bullish, like really conservative assumptions. You get half that IRR on just dividends. So and the multiples are so low. So at some point of time, that those IRRs are going to really expand. So yes, there is a definite positioning for such stuff in my portfolio. I think I think the difference to that is, markets like say Indonesia. You don't. I mean, it's hard on a bottom up basis to find too many great ideas for me. Maybe I'm not looking hard enough. You know, a lot of the investment into markets like India has been very top down. Indo has great demographics, good GDP to capita, blah blah blah. Okay, let's own the banks. Okay, but that's a very it's a levered play on the health of an economy, and the economy is not so healthy. So you're going to see NPLs, and we're seeing that. So I'm not going to take calls on the NPL cycle has peaked, not peaked, whatever. Um, but genuine bottom up growth stories are harder to find. So for me, markets like Indo, I've been very, very focused on the confluence of dollar earners uh, and some self-help, stories that are well run, and not too many names. Like hard to find too many such names. So that's
So
where
you
I'm on Indo.
so you would benefit if the rupiah depreciates further.
Yeah, I would. Yeah, that's how I'm positioned because I think it's sort of like a hedged exposure to Indonesian growth
Yeah.
by being that way. And then I think when you look at what are one or two themes that die must Indonesia has to follow, you just stick as close to them as possible, right? Like they have to open up tourism. It's a country with thousands of islands. They need to develop airports. They need that tourist dollar coming in. They've already announced they want six more Balis in the next few years. So I think those are interesting themes. And similarly, so I think it's slim pickings. I'll be honest. And not too many companies are reporting great earnings either. So I think it's good. The universe is smaller and easier to pick from. So that's been Indo. Thailand, I really struggle to find ideas where I see sort of a good secular story. I
Yeah.
like the hospitals. I think that's pretty much the only space there that I like. Um, I think Thailand has become very very adept at medical services now, and I think more and more people, especially as cross-border insurance becomes more prevalent. I mean, if Singaporeans can get insurance covered to go and get operated in Bumrungrad, why shouldn't they? Look at the cost of healthcare in Singapore, private healthcare.
Yeah.
It's insane.
It's a $100 flight. Very cheap.
Exactly. And then you are treated like a VIP. It's like living in a resort. They've got very good doctors. Do you remember like a year or so ago, I think it was around April, May last year, there was a Singapore Airlines flight coming from London back to Singapore that hit into this big turbulence patch just near Thailand, and they did an emergency diversion, landed the plane in Thailand, and everyone was shipped to a Thai hospital. I actually went and spoke to some of the people on that flight and what their experience was with um, healthcare there. I can tell you they were treated very well and they were very happy. Of course, very unfortunate incident, but they were very happy with the quality of care they received. So I feel that yeah, that's a pocket that's very interesting now, and it benefits from a weaker currency. But I think, unfortunately, with Thailand, a lot of what was very, very good about that country and market seems to be sort of ebbing away. The the auto sector. That whole Japanese auto manufacturing that moved to Japan. BYD has been opening one dealership a day, like not this year, but last year. What's going to happen to that whole manufacturing capacity that have been set up? I don't know. I think the jury's out, but I think Thailand really needs to reinvent itself. And some people have lost confidence in the political system, the democratic process, so to speak. So I think it'll take some time.
Interesting. Yeah. Okay.
Malaysia is very interesting. Malaysia is very interesting.
Really?
Yeah.
Based on what?
Malaysia,
Politics? Something else?
no, the economy. I mean, I think, like, honestly, I think the rate of change, the positive rate of change in Malaysia has been fantastic. It's one of the best performing currencies this year in Asia. I think it's up 6 to 7%, the ringgit. They're one of the biggest beneficiaries of digital infrastructure, the number of data centers being opened there. They will be the biggest beneficiaries of this RTS, the rapid train system that'll open from Singapore to Malaysia. It's an under-owned market. The domestic retail liquidity and interest in stocks is very high. ECM, corporate finance activity has been decent. Yeah, it's a perfectly good overlooked market, and it's actually like I mean that tech belt, that whole sort of Penang tech valley is it has promise. It can be built upon, taken to the next level. So the port sector, like look at West Ports and its results, doing very well, pricing power. Yeah, I think I would look at Malaysia more closely, and the market is pretty easy to access for people as well, compared to Indonesia and Philippines.
Interactive Brokers now offers access. I also saw that the insider buying in Malaysia is actually quite high. Like the number of buys to sells is among the highest in Asia, surprisingly.
Yeah, so I like to do these little road trips from Singapore into Malaysia and just explore. You should come with me next time I go.
Sure.
I find Malaysian corporates actually extremely friendly, and it's quite easy to get corporate access. And I think I think for a lot of people, Malaysia still means palm oil stocks and construction companies. But I think there's a lot more. Like I own a SaaS company in Malaysia, for example, in my
Hmm.
portfolio. There's
Interesting.
other stuff.
Okay. So you mentioned in the beginning private IQ. Is that the name of the platform? What are you doing there? What's Smart
Well,
Karma
let
doing
me
in private markets?
yeah. Let me just do one thing if I can. Um, so yeah, just change my virtual background so the name is clearer. So we've actually officially launched it today. The press release went out just a couple of hours ago. Um,
Cool.
but basically, for the last few years, we've been witnessing the the growth of privately owned market cap in Asia, but sort of more specifically in Southeast Asia. We've also been seeing the amount of new capital being injected into private equity and VC. And we've also seen the lack of exits in the region. So roughly since 2004, about 74 to 75 billion has gone in, and only about 20 odd billion has found an exit. So there's about 50 billion that's privately held that needs to be public at some point of time. Um, Companies are staying private for longer. I think the mean age of companies staying private has sort of continued to grow as well. That's a global phenomenon that we've seen. The big picture, right? The TAM around private market research and data has grown to a very reasonable size. There's a lot of corporates. There's a lot of private investors, even family offices that have very large swaths of their portfolios now in private markets. But compared to public markets, there's very little credible research. There's very little data, at least in this part of the world. Large businesses. I mean, if I asked you for a report on Carousel, as an example, it's a business everybody in Singapore has used or knows about. People don't, it's not there. You look at the large digital wealth managers, Endow, Stashaway, Saif, they've grown to reasonable sizes. You're not going to necessarily get research on them. And there's a lot like that, right? Just a few examples. There's a lot of big payment companies in this part of the world, very big payment companies that will be multi-billion-dollar IPOs. There's digital banks. There's a lot. So with Private IQ, we wanted to leverage the research ecosystem that we've built in public markets, the technology stack that we've built, and also, you know, the I guess the credibility that we've built across the investor ecosystem, and kind of launch into private market research and data. We've also, done this at a time when the MAS and the SGX want to nurture and attract more IPOs to the market as well, which naturally means that people will be focusing on pipeline. And I hope that we will end up being, a large helpful resource in this space to the investor community.
So let's say I'm interested in Davos or Gcash or some other private company that you think is going to IPO soon. What information or what research do you think can they get on the platform?
So, the answer is today, nothing. But in 12 months, deep dives, everything, details around the rounds that have happened, the transaction values, fundamentals, interviews with management, transcripts, data, a lot of data. Like, we have a lot of fundamental data for public markets, private markets, very patchy. Then data around the principals, cross shareholdings, what else do they own, etc. So that whole taxonomy that we are very accustomed to receiving very easily for public markets, we'll be building a mirror of that. And our first target is 75 companies that are sort of the most interesting companies in this space from a capital markets perspective. So in the first year, we will try and get to that sort of coverage across these 75 companies. And we've mapped out the verticals, the sectors and segments, and the prioritized approach. And we've built a unit of analysts who are going to focus their time in a devoted way to doing this.
Cool. And who are the target clients? Who will be interested in this kind of research? Are they interested in pre-IPO deals, or
yeah? So look,
yeah.
I mean, as we were working towards this, we were quite blessed to get support from the Singapore VC Association, which actually represents VCs and private equity. There's about 300 members in it. I think they welcome the idea of us launching something like this. So I think that's one constituent group, right? There's Singapore and has been able to attract a large number of PE and VC investors. So that's one main constituent. I think the second big constituent for us is family offices. I think family offices like private markets a lot. Maybe a lot more than I would like them to like, but they do. And a lot of them are shown deals, but they don't have any research on them. So Private IQ will also provide bespoke research services, which can be commissioned on a sort of per project basis in case things are not already readily available in our database. So I think we're going to go after those. I think the other is advisors. So a lot of the people who are advising private companies, whether it is, emerging tech focused merchant banks, investment banks, or it's even, IR, PR advisory firms and so on. I think we're going to work closely with them as well. And Private IQ will also partner up with Smartkarma's other business unit, which is called Engage IR, to help management teams of private companies also build out institutional investor ready IR and IR capabilities.
Okay. And compared to public markets, what do you think are the main pitfalls of investing in private market or pre-IPO deals? And how do you think the platform can help them?
I think you just do not have too much independent research on private companies or any at all. I think the level of scrutiny and the number of devil's advocates that exist in public companies helps create much better price discovery. And private markets tend to be very momentum driven, and you do not have people highlighting risks or spending enough time looking at principal risk, asset risk, fiduciary risk in some of these assets. So I think we want to be a good independent voice that talks about all of these. Of course, also the merits. So I think that's huge value add, right? It's any opaque asset class that is $50 billion worth already and growing deserves to get some objective independent research and data around it. So I think that's one important thing. I think the other thing that I've noticed is I just somehow cannot understand how private markets trade at, in many cases, enormous premiums over their public market counterparts. But we know that longer term public and private markets are converging. So I think being able to bring the right comp sets and talking about public and private markets in that same matrix is very important. Otherwise, many private market investors are very, very surprised when the company finally gets to market. Why is it that the multiple is so much lower than where they invested, despite growth rates still being at roughly the same levels? So I think it's just about not everybody in private markets still is, has the sophistication of the large PE boys who have a lot of resources at their disposal. So I think we can help them a lot in that space.
Do you expect a wave of coming IPOs then? I mean, if the private markets have grown this much and you're saying the exits haven't materialized yet, so what's
Yes,
keeping
absolutely.
what's keeping the IPO markets in Asia and beyond to really take off yet?
I think the first thing was just valuations. The difference in valuations between private and public was so steep. Like public markets are trading at such low valuations. How do you exit without losing existing investors a lot of money? So, and there are more and more pools of private capital, so they'll just keep funding it in the private market, waiting for the public markets to re-rate. But I think this is where exchanges like SGX become very interesting now, because the market has re-rated and is going to continue to re-rate if what we discussed at the beginning of this podcast continues to bear fruit. Then you can start to see exits. That's part one. Part two is just IPO rules. I think some of the markets here have not looked at their IPO rules in a while, and others have done it. So again, I think if you, maybe topic for another discussion, but I would recommend looking at how SGX has just announced a consultation on streamlined IPO rules. I think this really opens the door for emerging tech companies to come to market. I mean, look at Cathie Wood's sort of strategy in the US, right? A lot of the companies that she invested in were pre-profit, even pre-revenue in many cases. Well, most bourses in Asia don't even allow those types of companies to even be listed. Now, you and I can sit and argue whether they should be listed or should not be listed, but there has been regulatory arbitrage. So I think certain exchanges are now closing that, and they're putting the onus back on investors to do their own diligence. Why should a marketplace not allow a certain type of product so long as they have the right level of disclosure and transparency, and let investors decide what the price should be? So I think the market is going to really explode. I think people are underestimating how busy ECM will get in this part of the world.
Interesting. Cool. Is there anything else that you want to conclude with, that you want to communicate with us?
No, look, I think, Michael, thank you for championing Asia in your publication, despite what has been, foreign markets for Asia overall. And I think you and your audience have done a great job at doing that and sticking to that. And look, I think continue to do that. I wish you all the best as well.
Thank you, Raj. And lastly, anywhere, where can people find you online or even offline?
Well, you can sign up to Smartkarma, get a free account, get a paid account, and you can drop me a message there. I'm also very accessible via LinkedIn. Yeah, I think those are two easy ways to get hold of me.
Fantastic. So that's Raghav Kapoor, Smartkarma. Yep. Okay, so thank you so much, and hopefully we'll see you here again sometime. Thank you.
Take care. Bye-bye.
Bye.